Hello, welcome to the AHIF YouTube channel. I've got Xander here from Jones Lang LaSalle, who's just come away from his presentation earlier today. Now, Xander, you've the JLL and yourself, especially, has put a lot of effort into the sentiment survey. Sure. So why don't you explain a little bit about the survey and what findings it's brought?
Sure. So we've been looking at Africa for quite some time. One of the things that we've been trying to map out in Africa is where the capital is coming from, and one of the key challenges is clearly how do we, as an industry, attract more global capital coming into hotel investment. So what we did is we focused on 50 of the larger investment companies looking at hotels, and we had a look at the type of target returns that they're looking for, the barriers of entry, to try and create a international benchmark for Africa against some of the other regions that we track.
And what were some of those? Let's start with the barriers of entry.
Yeah, sure. One of the key findings, certainly of our study, is that there tends to be a fairly high risk premium which global capital attaches to hotel sector in Africa, right? So if we're looking at it on a global basis from an IRR perspective, so internal rate of return, primarily looking at the investment side of investment metrics for developments, right? Yeah. Globally, we're sitting at about 16.1% target returns. In Africa, we're generally sitting about 20 to 25%, right? If we're looking at pure investment plays, so looking at existing properties, in Africa, we're generally sitting at about 8 to 12% target yields. Globally, we're sitting a little bit closer to 7%. Okay. So what that means is that international investors are attaching about a 30 to 40% target premium on investment in Africa versus globally, and one of the challenges with that is that there's a lot more local players who are able to target lower returns because they understand the risk better, and there's a lot more local investment as opposed to global investment coming in.
This is the first report, I guess, in Africa, but what's your feeling on how that might be changing? Do you think that is moving to a more positive or more negative position?
Yeah, so I mean, if we look at an investment outlook generally, the long-term outlook from international investors is more positive than short-term. Yeah. And I think that's natural because you've got an industry that's clearly maturing. It's an emerging market. And what you're seeing is that people are seeing more opportunities in the long term because you've got investment grade assets being developed right now. So they should be available for sale or some sort of liquidity event in the next 5 to 7 years. Yeah. And there's a lot of investors that are not happy to get in on the development side of the investment scale. So I think certainly in the next 5 to 7 to 10 years, we're going to see a really big change in evolution in terms of global capital coming in, as and when we're getting more properties being brought to the market.
So you mentioned obviously barriers of entry, and I don't mean to ask the same question twice, but then what can a project do to make themselves more attractive now than for global investment?
Right. So one of the key focuses of investors in terms of where they're looking for target assets and target investors is they're very much looking for corporate focused hotels in gateway cities. Global brands play a very big role in providing that additional stability to investors. Yep. So certainly if you're looking at putting together a project, that's kind of the sweet spot of where people are looking. Of course, certain markets are stronger than others. Yeah. I mean, at the moment, we're seeing a lot of interest in East Africa from the investment side, and certainly with the oil price coming down in the West, that's come down a bit. So I guess you need to be in the right location, in the right city where investors are looking, but it's also making sure that you have a market that they're targeting that's relevant for investors.
Okay, final question then. How can governments get involved here and make themselves more attractive as a proposition?
So when we looked at our barriers of entry in the top 5, there were 2 which are pretty critical. One is political risk and political stability. The other one is access to foreign exchange, and that's a key issue for a lot of investors. You know, a lot of investors are happy to put the money in and to benefit the economy and you know all the positive effects that come with that. But clearly there needs to be an opportunity to take that out through dividends or upon exit, and that's often not optimally facilitated by governments at the moment. So those are certainly 2 areas that we would target.
Well, thank you, Xander, for your time
Thank
today and your efforts with the survey. Thank you, everybody, for listening. Look forward to speaking with you soon.